Hello, everyone, and welcome to the beginning of the fourth quarter already. We've got less than 30 days till Halloween. We've got about 6 or 7 weeks before we know it. It'll be Thanksgiving. The temperatures will start getting cooler up here in the northern U.S., Midwest, where we live. Before we know it, it'll be Hanukkah, Christmas, and New Year's, and we'll be sitting face to face with 2022. So we've got a lot to go over today, so I'm not going to waste too much time chit-chatting here. So why don't we go ahead and jump right into the material, starting with a quote as always. This is David Tepper, who was a former hedge fund manager and philanthropist. He said, "This company looks cheap, that company looks cheap, but the overall economy could completely screw it up. The key is to wait. Sometimes the hardest thing to do is to do nothing." I heard a similar quote a long time ago from one of my mentors who said that sometimes the hardest thing to do is to do nothing at all, which is obviously pretty much the same quote here. But it's I think sometimes, depending what's happening in the news, what's happening in the economy, what's happening with the stock market, too many times I think we feel like we need to do something just for the sake of making a change, when sometimes making a change is the last thing you want to do. So right now, I'm going to look at what the market looks like today. This is what I call my pre-flight checklist. I look at this every single day when I open up my research software called Optima. It's an incredible piece of software that does so much of my work for me. But what this is I don't want to go through into all the details here, but red is obviously bad, blue is good. On the left-hand side here, we have short-term trends, which are generally, for the most part, down. So the eight-day moving average is below the 8-day moving average is below the 21. The 21 exponential moving average is sloping down, not up. That's why it says false here on both the S&P and the Qs. And the S&P and the Qs are both below the 8-day moving average. If we go to intermediate term trends, and the reason I use 21 days, by the way, is because 21 days is 1 month. It's 21 trading days. So when we look at the intermediate term trends right now in the market, both the S&P and the Qs, the Nasdaq 100, are below their 21-day moving average. The 21-day moving average is below the 50-day on both the SPY and the Qs. And then the slope of the 50-day moving average is both down on both of these indices. And then last but not least, when we look at the long-term trends, you can see that the S&P 500 and the Qs are both below their 10-week moving average. The 13-week, which is a little bit longer, the slope is down. The only thing that's left at this point that's up on a long-term basis is the 13-week moving average is still above the 34-week moving average on both of those indices, which I wouldn't call that a good thing. I would say that the long-term trend is hanging in there. And as long as those stay positive, I think that there's a lot of hope that we could see maybe a buyable dip coming at some point. But I don't see what we're seeing in the market right now. I don't see that as being, your stereotypical 2 to 3% drop that you can just buy into and expect the market to go up 5%, like we've seen a lot of the times throughout the prior, we'll just call it 12 months or so. When we look at market climate up here in the upper right-hand corner, I don't share all the details here because, again, I want to keep this pretty surface level. But you can see we've got about half of it's red, half of it's blue, so kind of neutral if we look at market climate. And then when you see here, this is a little category called, I call it safe for new entries. So whether or not it's safe to buy new positions. You can see that generally speaking, we're looking at mostly red with a little bit of blue. So more, I would call that more like 65% red. And what that means is if I'm looking to buy new investments, I want to be very, very careful about what I'm buying, and I better be really convicted in whatever I'm buying to make sure that we're going to be swimming against the stream. See, when you look at the stock market, roughly 4 out of 5 stocks move with the market. So if the market's trend is generally down, if you're trying to buy stocks, it's going to be pretty tough to go against the stream or against the grain. I like stream better as an analogy because if the stream's moving against us, we're going to get really, really tired. Think of it like a riptide, and it's going to be counterproductive in most cases. Now, you can get lucky, which luck doesn't hurt, but you can get lucky. You can be a hero and find those 1 or 2 great stocks that end up making money in a market that's going down. But generally speaking, it pays to just kind of be patient, sit, wait for your pitch, wait for the right pitch, I should say, and wait for conditions to be a little bit safer. Bottom left-hand corner here, what we're looking at is the small cap index. I'm going to get into more of that in more detail in a second here. And then this is on the Qs here. So a Nasdaq 100, the Investo QQQ, which has been in the news a lot, or I should say commercials a lot lately. But you can see both of these are below water. Below water meaning this blue area is called the 50-day moving average, or it's the 50-day trend of the investment in question. And again, in this case, it's the Qs, the Invesco Qs. So these are underwater. You know, if we spend a little bit of time below water and jump right back up, no big deal. But if we spend multiple days below water, we have to be careful we don't let our portfolios drown on us. So moving on from there, I mentioned I'd get into this a little bit more detail. Here's the S&P 500, which is generally speaking, like I said earlier, every time the market were to drop, when I say the market, the S&P, if the market were to drop here 4 days is all, it would get bought up at the 50-day moving average and bounce right back up again. Right here, it comes down again in March pretty violently, pretty quickly. And then all of a sudden it gets bought right back up again. Falls again 1, 2, 3, 4, 5, 6, 7 days. Gets bought again at the 50-day moving average. Heads up, goes down in 1, 2, 3 days. Gets bought at the 50. Goes up for 2 days, down for 3, bought at the 50. And you can see I don't have to keep repeating myself here, but it keeps being bought at that 50-day moving average. And this time it didn't. And that's what's important, is when something tends to work over and over again, and then that stops working, that's evidence we want to pay attention to here. So it fell below the 50-day moving average, the 50-day trend, tried to get back above water and take a breath, and now it's heading down again. In fact, today, as I record this screencast intraday on Monday, the market is down pretty big again today. Now, when we look at the market, the next thing I think that's really, really, really important, crucial really, to understand is that the S&P 500 is just an index. And when I say that it's an index, it's a basket. It's a basket of 505 stocks. Not 500, but 505. And inside this basket are a bunch of large, mid, and small cap stocks. Now, when the biggest stocks go up, the index goes up. When the biggest stocks go down, the index goes down in value. When the smallest stocks go up, the index doesn't really move at all. When the smallest stocks go down, again, the index doesn't really move at all. The analogy I always use, which I got from Tommy Dorsey, one of my earliest mentors, is it's kind of like Congress and the Senate. If the S&P 500 were equally weighted, where every one of the 505 stocks got an equal weight, then that would be like the Senate, where every state in the union gets the same number of senators. But that's not how the S&P 500 is constructed. The S&P 500 is constructed as what's called a cap-weighted index. And so what happens is, it's like Congress. The bigger the state, the more congressmen we have, or congresswomen. So when we look at the stock market in the S&P 500, the biggest companies, so think Apple, Microsoft, Amazon, Netflix, Google, these big companies make up 20-25%, depending on the day or the week, of the S&P 500. So if any one of these few companies out of 505, if any one of these few companies has a really good day, it makes the market go up or down. So let's just say that the tail can wag the dog, metaphorically speaking, pretty easily here. So now that we understand that, we can't just look at the S&P 500 and say, if the S&P 500 is going up, then that means every stock and every investment's going up too. That's not the case. In fact, what you're looking at here on this screen, in the bottom half, well, let me start with the top. The top is the S&P 500 with its 50-day moving average again. So this is the 50-day trend up top. And now finally, after this last few weeks, we've finally seen the market taking a breather. When I say the market, this is the index, the basket. And the reason it's taking a breather is because those big companies are finally taking a breather. But what's been happening for a long time, you can see here in the bottom pane, is that the percentage of stocks inside the S&P 500 that are above their 50-day moving average. So in other words, here's the S&P and its 50-day moving average. If you were to analyze every individual stock inside the S&P 500, 31% of those stocks as of Friday's close was above the 50-day moving average. In other words, 69% of stocks were below this blue trend line, which is obviously not good. And it certainly, when you look back here, this is 70%. When you look at June, it was sitting at about, well, pretty much where it is today. So in June, even though the market was technically, the basket, I should say, the S&P 500 index or basket was very clearly above its 50-day moving average, what we were seeing is a decline and the number of stocks above their own 50-day moving averages. So think of it like looking at a patient. A doctor looks at a patient, and on the outside they look just fine, but they feel sick inside. This is the market over the last several months, since April really, getting sicker and sicker and sicker, trying to feel a little bit better here between June and August, but then continuing to get sick here, and now all of a sudden the symptoms are starting to show on the index, as well as we'll call it the doctor's indicator, so to speak. So that's the percentage of stocks below the 50-day moving average. Now the next one I want to show you is again the S&P 500 at the top, but this is the percentage of stocks in the bottom pane here, the percentage of stocks within 20% of their 1-year high or 52-week high. So now we're looking here, again, as the market's been going up, I mean, when I say the market, the index has been going up, the percentage of stocks within the index has been going down, and that is the percentage of stocks within 20% of their 52-week high. So 15% of stocks as of Friday's close are technically lower than 20% below their 52-week high. The last one I'll show you here, and this is one that we paid a lot of attention to last year, and that I'm looking at this every single day. And this is a breadth indicator that looks at the percentage of new 6-month lows. So I purposely drew this all the way back to COVID. And the problem with COVID, of course, was that it happened so fast. Never in history have we seen the market go down 34% in 22 days, ever. I'd like to hope that we'll never see it again. Personally, I hope we'll never see that happen again. But it happened. It was faster than, from top to bottom, it happened faster than Black Monday occurred, even, if that's hard to believe. Now, Black Monday was the biggest one-day drop, but from top to bottom, COVID was a faster crash from top to bottom than Black Monday was. But anyway, I digress. What we're looking here in the top is the S&P 500, in the upper pane with, again, the 50-day moving average, and the bottom pane is the percentage of new 6-month lows of stocks within the S&P 500. So what we're looking at in the far right here is currently we're just not seeing a whole lot of that. So as of Friday's close, 9% of stocks within the S&P 500 are printing new 6-month lows, which, if you stop and think about it for a second, how could the market be going up? And if you look at 6-month lows, so September, we'd have to go all the way back here to, call it May, March, April, May-ish. You can see here, we would have to see the market going down and hitting new 6-month lows for it to look like that 9% of stocks that are hitting 6-month lows. So what I'm trying to say here is try to imagine that almost 10% of the stocks within the S&P 500 are actually seeing new lows as of 6 months ago. When you compare it to the stock market, which obviously is not anywhere near that. So what we want to watch for here is we want to watch to see that these new lows don't continue getting higher and higher spikes, because the more 6-month lows we have within the basket, under the surface, underneath the patient's skin, the sicker the market is, and we're just not seeing it on the surface, again, being the index. Moving on, I know I already hit the S&P 500 to death, but this is the Nasdaq. So this is the more tech-heavy, high-growth volatility index that we have to compare. When people talk about the market, usually they say the S&P 500. Some people like to use the Dow. I don't like the Dow because it's only 30 stocks, and it's only 30 large cap stocks, and that's it. But anyway, so here's the Nasdaq, which is a very tech-heavy, more volatile index, and you can see here it's kind of been choppy all year long, with current prices sitting, well, I shouldn't say sitting right at where they were in February, but kind of closing in again today. The Nasdaq is down as I record this screencast, and it's getting closer to its peak in February. When we look at the small cap index, this is what I think really tells the story here. The small cap index, which is the Russell 2000, that's 2,000 small company stocks. In order to have a really, really healthy market, you have to have small caps doing well. You have to have small companies growing and prices going up. And what we've seen is, since the beginning of the year, this small cap index has gone absolutely nowhere. I used to say that as of February 12th, which is right here, that the index had gone nowhere. But now we have to go back further than that. And depending on what happens here, I'm looking at my TV, by the way. Depending on what happens here in this next few days, we could see this index heading lower. But what I'm really hoping is that we can hold this, call it, 211, 212, 210 area where it's bottomed over and over and over again. And as long as we can stay within this range, then I think we're okay. This is the top 50 growth stocks, Investors Business Daily, IBD, or Investors Business Daily has their what's called their top 50 growth stocks. And this is, as you can see right here, it's just barely underwater as of Friday's close. But again, just like the small cap index, pretty much in the same place as it was at the beginning of the year. So even the top 50 growth stocks have been struggling, with the exception of maybe a little blip of life here that we saw, which broke out of the range, but now it's right back into the range again. So we're just going to have to see what happens. And I guess that brings me to, I keep saying in our client meetings with the people who like to nerd out with me that it's all about small caps this year. If this is the range, going back 8 months, we got this bouncing, this ping pong back and forth and back and forth. If we can get small caps to break out, then as the saying goes, the higher the base, the longer the base, the higher in space. But if it works the opposite too. So just because this is going sideways and building up like a pressure cannon, like a potato cannon, if it breaks down, it could break down hard just as much as it would break out hard if it breaks out of this range. Right now, nobody knows. We have no clue whether this is going to break out or break down. So at least for now, the plan is to sit, wait and watch, see what happens, and let the market prove to us what it's going to do so that we can follow the trend. Moving on, what we're looking at now is bonds. So bonds have been a mess. It's from the early 80s until about 2-3 years ago. Owning bonds, all you had to do is just buy some bonds, a diversified portfolio, and hold on to them, and you were making money. Not only were you making money because interest rates were going down and principal was going up, because that's how bonds work. Remember, bonds are inversely correlated with interest rates. So when interest rates go down, bonds go up in value. When interest rates go up, bonds go down in value. So for 3 decades, 35 years, you could just buy bonds, collect the interest, and the principal went up as well. So what you were getting is pretty conservative growth and income, which was then reinvested if you held it into more shares, which then grew more, and so on and so forth. Now it's a different story. You can see here that bonds today, this is the 20-year Treasury bond, by the way. Bonds today are sitting at exactly the same place, and this is as of Friday, by the way, 145.34. If you go all the way back to the end of 2019, they're at the same place. They went as low as 134, 135-ish. Peaked out at 179, went down again to around 133, 134, peaked out in the 150s, and now we're sitting around 145. So this is a very, very strange environment to be in when it comes to managing a bond portfolio. And what that also means is that if you're in a more conservative portfolio, then what used to be bonds or the bond sleeve of your portfolio, which in conservative portfolios typically are larger portions of your portfolio, usually it would be kind of a steady and slow growth, where now bonds can actually work against you. And it's not as easy, or I'm just going to say it how it is, it's a lot more difficult to make money in bonds than it used to be. And one of the ways we can do it is by shorting the bond market. Now, I don't want to get too into the weeds here, but this is the yield. So here's the Treasury yield. The problem with with yields is we can't buy them. You can't just buy the 30-year yield or the 10-year yield because there's no way to do that. But what you can do is you can short the bond market. You can buy ETFs, is what we do, that short the 10-year Treasury or short the 20-year Treasury. And what that means is when the Treasury bonds are going down in value, then we're making money. In other words, when interest rates are going up, we're making money, where usually when interest rates go up, bonds go down. When you're shorting it, you're doing the opposite. What you're doing is you're profiting if it goes down in value. So it's kind of like, try to think of it like buying rates, even though there is literally no way to do that. So anyway, when we look at the 30-year, this is the 30-year note, Treasury yield note, you can see here that it's back above water again. And so yields are actually starting to do well. Which is, there's a number of things that could mean. That could mean inflation. That could mean financials are going to do well. That could mean utilities are not going to do so well. We're just going to have to see what happens here. But as we look at our bond portfolios, and I pull up a relative rotation graph, I also find it extremely interesting here. Really hard to see, by the way, but this is the short 20-year Treasury and the short 10-year Treasury are starting to curl up out of the lagging quadrant, pointing northeast into the improving quadrant, all while the 25-year zero coupon bonds, and the 20-year Treasury, and then this is corporate bonds here, VCLT, those are all curling down out of the leading quadrant. In other words, they're no longer leading the bond market as a whole, and they're starting to decline and weaken versus the bond market, or the AGG is the index that I use as a whole. So what we're looking at right now is kind of a neutral position to almost leaning toward wanting to buy those rates. In other words, short the bond market. And that's just what the weight of the evidence is telling us. That's what the market's telling us. If we switch gears, since we're talking about relative rotation graphs and we talk about stocks, so U.S. stocks, this is a U.S. equity RRG inventory that I keep. And some of the stuff that you see is starting to weaken are things like lithium in the leading quadrant right now, but starting to weaken or pointing towards the weakening quadrant. Here's growth stocks. We're seeing the Koós, in other words, technologies weakening. Uranium stocks are starting to weaken. Blockchain, robotics, AI are starting to weaken, all while things like airlines, like JETS is the symbol, JETS, is a basket of airline stocks, regional banks, things like that. Financials are starting to see some improvement. Down here, this is small cap energy, PSCE, is starting to head northward in a northeasterly fashion, pointing toward the improving and leading quadrant. So that's all indicating that perhaps we're starting to see a rotation out of the more growth-oriented stuff into the more value sectors. On the far left here, we see this is kind of an anomaly, but this is MSOS is a marijuana stock ETF. It's a basket of marijuana stocks. And then GDXJ, that's small company gold miner stocks. Now, gold and gold miners have not been doing very well for a while, but it's interesting to see that it's starting to come out of this lagging quadrant. And as it starts to point northeast, that means that we could start to see some growth out of gold miners. I'm just going to briefly touch on this because, again, we were looking at relative rotation graphs, so I thought I'd pull this up. This is individual stocks. These, you can see that some of the individual stocks within the S&P 500 that are starting to really improve or beat the market are things like Netflix, AIG, Cabot, M-Chip here, Huntington Bank. So as you look at all these stocks over here on the far right, what these are telling us is that these are already beating or leading the market currently. When you see the ones down here in the bottom left, these are ones that have been, or stocks that have been underperforming the market that are starting to show signs of life. The stocks that are already improving versus the market, like Viacom, and the companies like Wynn Resorts and Las Vegas Sands, Micron, these companies, Southwest Airlines, which is LUV, all these companies are starting to see some life here, which indicates that perhaps we won't see such a strong coronavirus outbreak this winter. At least that's what the market's showing us when you see these more open the economy stocks starting to improve in value. When we look at the market as a whole from a 30,000 foot view, so we're scanning out here. This is every asset class from, again, 30,000 foot view asset class. We've got commodities up top, number one ranked asset class. Small cap U.S. stocks are now number two. That just flipped over here this month for the first time in a long time. Then we have the S&P 500 ranked third, international stocks ranked fourth, cash or money market right here ranked fifth, and then last but not least we have bonds ranked in the basement at sixth. So here again, this is just this is not really micro analysis. This is really looking at things from a 30,000 foot view, really scaling back and looking at things from a far distance. And what this is telling us is that perhaps commodities could have the edge here. And in fact, when we talk about commodities, what's interesting is usually gold tends to be one of the commodities that outperforms when you see commodities doing well. When in fact, what we've seen since this last summer is gold has been down. So last summer, gold peaked out at around 2060 or so. I'm just guessing here, drawing a line in the sand over to the right, so around 2060 per ounce. Now, as of yesterday or Friday's close, it was sitting around 1758 an ounce. And what we're starting to see is a similar positive divergence and momentum here that we did back in March, where you saw gold pop and kind of take a short-term counter-trend rally before it headed downward again. This time, it's a little bit longer divergence. So this one was pretty short, maybe just a month or two. This one's a little bit longer. So I'm starting to wonder, will we see gold help participate in commodities increased performance or not. Perhaps it just continues down or continues to chop sideways, but things like energy and other commodities have been what have been making commodities do well, which again speaks to the inflation trade. If inflation goes up, commodities have a tendency to do well. So this is going to be interesting to see what happens with gold here over the next several days and weeks. Last but not least, I shouldn't say last but not least, I've got a couple more things to show you here, but I feel like I couldn't finish without talking about Bitcoin. Right now, this is Friday's close. Obviously, we know that cryptocurrencies trade every day, all day. And when you look back, this red line is, in my opinion, the line in the sand that I think we need to be paying attention to. So right around 41,000 on Bitcoin is the most recent low. If you go backwards, you can see a congestion right here where it popped above 40,000, popped back below, and popped right back above again. If you go backwards to June, this looks like pretty solid resistance here. Tried to go above 41. It couldn't, failed. Broke down here, obviously at 41,000. And if you go all the way back to 2021, the beginning of the year, it peaked out at that 41,000 mark and then headed down and then was able to break out. So if I rewind from history going into the beginning of the year, we hit 41,000, fell, then we broke through it, pretty big breakout here, and headed higher up to around the 62, 64,000 mark, and then broke through that potential support, couldn't get above that ceiling, broke down again, congestion, broke above it, and so far we're holding. If we hold above that 41,000 mark, I think that Bitcoin is fine. But if it heads below that level, what we're seeing really is potentially not only a lower high right here, so here's the previous high, this could be a major lower high, but if it breaks down, we could see ourselves with a lower low as well, which obviously would be more of a long-term downtrend, and perhaps it might take a little bit longer for Bitcoin to see higher prices. All right, so the last thing I wanted to share with you here is the average performance during October. So you can see here since 1950, the average performance of October. This is the last 20 years, 10 years, and post-election years. So we finally found our way out. Granted, the first week or two of the year tends to be a little bit volatile for October, but we did finally get out of that August and September timeframe, which are typically not very good months for the market. In fact, September is the worst. August is the second worst. So now we're moving into the better months of the year, and really the best quarter of the year, which is the fourth quarter for the U.S. stock market. I'll go ahead and end there. But if you have any questions at all, please feel free to reach out to us. We can be reached at info@libertaswealth.com. If you want to go to our website at libertaswealth.com, you can also send a form message and set up an intro call. That's our first step. If you'd like a second opinion on your investment management portfolio, if you'd like a second opinion on your retirement plan, financial plan, estate plan, and so on. If you don't have a financial plan, retirement plan, estate plan, by all means, please reach out to us. I believe that everybody needs a financial plan, and if you don't have one, it's kind of like trying to go on vacation without a destination in mind. So let us, if you don't have one and you don't already have a financial advisory firm that you're working with that you know, like, and trust, then allow us to put together a plan for you. We do not charge for our plans if we're managing your money for you and investing your money. If you want to manage your own money and do all the investing yourself, we do have a fee for that, which depends on the complexity of the plan. But at any rate, I'll digress here. Feel free to reach out to us, though, and the first step is always just an intro call. You never have to be a client to ask a question, and we'd love the chance to just get on a phone, chit-chat, hear your story, what you've done for yourself in terms of retirement planning, retirement income planning if you're already in retirement. And I guess I'll just end there for the day. Hope you had a wonderful summer, that you start to enjoy some of these amazing fall months. It's my favorite time of year. It's fire pit time. It's college and football time. I was going to say college and NFL time, but college football time. It's NFL time, finally, for me as a Browns fan. Starting to see some life out of my Browns up in Cleveland. So I hope you're having a wonderful fall, and I'll look forward to hopefully talking to you soon.